Definition and features of Black Thursday. Black Thursday is one of the largest stock market crashes in history, which occurred on October 24, 1929. This crisis is the name given to the major collapse in the American stock market and led to a global economic downturn. Black Thursday occurred after a period of economic growth and prosperity in the late 1920s. During this period, the stock market in America was rapidly growing, and many investors saw the opportunity to become wealthy in this market. However, when this period of growth came to an end, stock prices in the market had soared to excessive levels, and investors had accumulated excessive debt. Additionally, banks had taken on excessive credit risks by providing excessive loans for stock investments. On October 24, 1929, stock prices began to decline rapidly. Initially, a few major investors started selling their stocks, and then other investors followed suit. This situation led to a rapid decline in stock prices and a major collapse in the market. People experienced significant losses as the value of their stocks plummeted, and many investors went bankrupt. So, Black Thursday is considered one of the greatest economic crises in world history. What were the causes of this crisis? During the period of Black Thursday, many investors suffered significant losses due to the decline in stock prices. How were these investors affected by the crisis? How did Black Thursday affect global economic balances? For all this and more, before starting the video, if you're interested in universal economic history, you can subscribe to my channel and turn on notifications to be informed about new videos I upload every day. Enjoy the watch.
Universal economic history.
Excessive borrowing by individuals and companies is often a fundamental cause of many crises. Individuals can accumulate excessive debt through credit cards and other borrowing methods, which can lead to an economic crisis. Similarly, companies finance themselves through excessive borrowing, and when their debts reach unsustainable levels over time, they may go bankrupt. Speculation, which involves predicting the future value of an investment and purchasing it at a price above that value, can lead to excessive price increases and, in turn, trigger an economic crisis. Speculation is commonly observed in the stock market or real estate sector. Economic crises are often a result of significant economic imbalances. For example, overproduction, low demand, high unemployment, inflation, and other economic issues can lead to the emergence of crises. Banks and other financial institutions may fail as a result of other factors that cause economic crises. For instance, when banks make excessively risky investments or when the majority of investors withdraw their funds from the banks, financial institutions may go bankrupt and cause economic crises. Some crises may arise as a result of political and social factors. Political turmoil, wars, or natural disasters, for example, can lead to the emergence of economic crises. These reasons are just a few examples of the causes of economic crises. Economic crises are often complex and multifactorial, so they usually do not arise from a single factor. The 1920s was a period that brought significant changes to the world economy after World War I. During this period, the United States strengthened its position in the world economy and shaped the changes in the global economy. The industrial sector experienced rapid growth, and production levels increased in America. Many new technological developments emerged during this period, such as automobiles, electric appliances, and electronic devices. These advancements increased production levels and contributed to economic growth. Industrial growth led to increased consumer spending and higher levels of consumption. This resulted in the growth of the retail sector and increased production of consumer goods. New job opportunities and higher wages were created. During this period, factory workers and other laborers demanded higher wages and better working conditions. The 1920s were a difficult period for the agricultural sector. Overproduction, low demand, and low prices adversely affected the agricultural sector and reduced farmers' income. The stock market and other financial markets experienced rapid growth. New financial instruments provided investment opportunities, such as stocks and bonds, enabling people to invest. The 1920s brought significant changes to the global economy. The leadership of the United Kingdom declined, and the United States became more influential in the world economy. The growth in the stock market led to speculation by some individuals, causing inflated stock prices. Some investors attempted to increase stock prices by buying stocks and selling them at a higher price later. In the 1920s, margin trading became widespread. In this process, investors borrowed money to buy stocks and repaid their debts by selling the stocks later. This process inflated stock prices but also created risks. The growth in the stock market also led to the introduction of stock market regulations. In the United States, the Securities and Exchange Commission, SEC, was established to regulate the stock market. The growth in the stock market eventually led to a major economic crisis in the following years. In 1929, stock prices plummeted rapidly, causing significant losses for many individuals. This event marked the beginning of the Great Depression, one of the largest economic crises in history. October 24, 1929, is known as Black Thursday because a major collapse occurred on that day in the New York Stock Exchange. On Black Thursday, stock prices experienced a significant decline in the stock market. Many investors suffered substantial losses. The decline in value concerned a significant portion of investors and caused panic. This led to further stock selling and a further decline in the stock market. Later in the day, the stock exchange management decided to close the market to prevent further losses. The collapse in the New York Stock Exchange had a global impact. Stock prices fell in many countries, and the global economy was affected. Black Thursday marked the beginning of a major economic crisis, and in the following years, this crisis led to the Great Depression, one of the largest economic crises in history. Black Thursday is considered a turning point in the financial world and is still studied and analyzed by many economists today. Black Thursday's major stock market crash had significant consequences for both the U.S. economy and the global economy. Black Thursday marked the beginning of the Great Depression, one of the largest economic crises in history. This crisis led to millions of people worldwide losing their jobs, many banks failing, and widespread economic distress. Black Thursday caused many investors to suffer significant losses. The decline in the stock market's value resulted in many people losing a significant portion of their savings. The collapse of the stock market also led to the failure of many banks. Bank failures resulted in millions of people losing their savings and contributed to a major economic collapse. During the Great Depression, poverty and unemployment rates increased. The number of unemployed individuals rose rapidly, and many people struggled with poverty and hunger. After the Great Depression, the U.S. government and other countries enacted new laws and regulations to regulate and oversee financial markets. These regulations aimed to prevent a similar crisis from happening again. The Great Depression caused by Black Thursday affected many sectors and countries worldwide. The agricultural sector was deeply affected by the Great Depression. Farmers were unable to sell their products, and due to the increased unemployment rates nationwide, poverty and hunger rates also increased. The collapse of banks resulted in many people losing their savings. This shook people's confidence and trust in the banking sector. The automotive sector also suffered a severe blow during the crisis. Sales declined, and many manufacturers went bankrupt. The construction sector was significantly affected by the crisis. Construction activities halted, and many construction companies went bankrupt. The crisis also impacted Europe. Unemployment rates rose, and many countries experienced economic collapses. Latin American countries felt the impact of the Great Depression intensely. Poverty and unemployment rates increased, and many countries faced economic difficulties. Black Thursday's effects had long-lasting consequences globally, and it is considered a significant historical event that is still felt in many sectors and countries today. Many countries tried various methods to recover from the crisis. Here are some of the methods used to cope with the crisis. Many countries aimed to combat the crisis by increasing the money supply. By increasing the money supply, people would have more money and businesses would find it easier to borrow. Tax cuts helped increase the cash flow of businesses. Additionally, governments reduced certain consumption taxes to encourage people to spend more. Public investments helped stimulate the economy. Governments invested in public projects to reduce unemployment rates and support business activities. Lowering interest rates reduced borrowing costs for businesses, thereby increasing cash flow. Some countries increased trade restrictions to promote domestic production. This reduced imports and increased the competitiveness of domestic businesses. Governments attempted to combat the crisis through social programs to fight poverty and provide support to individuals. These programs aimed to assist unemployed individuals and reduce poverty rates. Some countries pursued international cooperation to address the crisis. By increasing trade between countries, economic recovery was facilitated. In addition to these measures, various other methods were tried to cope with the crisis. However, during the Great Depression, these measures were often unsuccessful, and it took a long time for the crisis to end. Black Thursday resulted in many people losing their jobs, savings, and investments. Unemployment rates increased, and poverty became a significant part of many people's lives. Additionally, the crisis had a negative impact on global trade and the world economy struggled to recover for a long time. However, the crisis also provided many lessons. Firstly, it highlighted the fact that taking excessive risks in financial markets can lead to instability. Secondly, it underscored that any fluctuations in the global economy can affect other countries as well. Thirdly, it emphasized the importance of strong regulation and supervision of banks to maintain stability in financial markets. Today, the world economy is still susceptible to crises, and therefore, efforts continue to be made to regulate financial markets, promote economic cooperation, and ensure financial stability worldwide. Additionally, investors and businesses strive to better understand and manage risks to protect themselves from crises. In conclusion, the historical impact of Black Thursday represents a significant turning point, emphasizing the importance of regulating financial markets and maintaining economic stability. The lessons from the crisis involve ongoing efforts to regulate financial markets, foster cooperation, and preserve stability globally. Thank you for watching my video. If you liked it, please hit the like button. If there's a specific video you'd like me to make on economic history, don't forget to mention it in the comments section. I wish everyone a pleasant day.
Universal Economic History.